This is the Blockchain Real Estate Podcast, sponsored by the Blockchain Real Estate Summit. If you're interested in the intersection of real estate, blockchain technology, AI, and more, you've come to the right place. Don't miss your opportunity to attend the Blockchain Real Estate Summit 2024, happening this September 24th through 26th, online for our worldwide audience. Get your tickets at blockchainrealestatesummit.com/registration. Enjoy the show.
Hey, everybody. We are really excited to have Luke Schimmel here from Avalabs. And one of the great things is that we've had a really good relationship with Avalanche and Avalabs for the past 2.5 years now. They're really interested in putting assets on blockchain. They've got a really cool EVM-compatible chain. And Luke is going to talk about their special thing about how they put together a grant for adding real-world assets on the chain. So without further ado, Luke, why don't you give us a little background about, how you got to Avalabs and some of the stuff that you did, because this guy's got some real-world credentials.
Yeah, absolutely. Thanks so much for having me today, Michael. I'm really excited to be joining you and speaking a little bit about what we're doing at Avalabs, the real-world asset space, and tokenization more broadly, and real estate. So a little bit on my background. The first few years of my career I spent in traditional finance. I was at Goldman Sachs on a number of different fixed income trading desks, specifically focused on the U.S. high yield bond market. That was where I spent most of my time. But during that period of time, I think crypto and digital assets really captured the hearts and minds of everyone working in capital markets. And I got to be a part of a few really interesting crypto adjacent traditional types of transactions. So things like the Coinbase IPO and inaugural bond deal. I ended up selling a lot of those new issue Coinbase bonds. I traded a bunch of the MicroStrategy convertible debt and the high yield bonds. We actually did 2.5 years ago around about the first public blockchain native bond deal for the European Investment Bank. So I was a part of that and got to kind of see one of those really early instances of playing around with this idea of off-chain assets and real-world assets and doing traditional types of capital markets activities on public blockchain rails, which was super, super interesting and early to be a part of. That kind of led me to Falcon X, which is a institutional digital asset brokerage. So I was doing a very similar job function in my role there. I was covering a lot of the large crypto native funds and also onboarding a lot of more traditional institutions into the space who, this was late 2021 and early 2022. We're still kind of chasing the crypto asset price action and looking to get some exposure there. But at the same time, we're doing a lot of homework and we're really educating themselves on the underlying technology. So throughout the latter portion of 2022, really saw a pullback in the demand from institutions to get exposure to, assets like Bitcoin and ETH and AVAX, right? But continued to kind of see into the latter half of 2022 this burgeoning interest in using public blockchains for, something like asset tokenization. So I did spend some time as well at Maple Finance. I know Sid Powell, the CEO of that protocol, is kind of involved today and is speaking as well. One of the really early real-world asset RWA protocols in all of DeFi, a really, really cool debt capital markets platform that's fully on chain, and just a great example of, why you would run something like a lending business on a public blockchain versus, completely off chain. And I'm sure Sid probably touched on or will touch on a lot of those benefits.
He's definitely going to cover that. And one of the things that we're working with is we've got some partners that have a hotel debt fund. So we're working with Sid to see if we can actually get some, hotel debt on chain. So that's going to be pretty exciting. So we're
Awesome.
looking forward to seeing him. And that's the type of stuff that we're looking forward to hearing about, Avalanche and some of the stuff that can be done on Avalanche.
Yeah, absolutely. And I was just about to get into that. So about a year ago was when we really started to see a lot of interest in this idea of tokenization, particularly around a deal that we tokenized for KKR in partnership with Securitize. So essentially what that was KKR coming to us and to Securitize and saying we want to tokenize a portion of our flagship healthcare growth fund, and essentially, try to see what are the efficiencies here. What does this allow us to do? There's a kind of a broader theme across alternatives and private equity of trying to open up new distribution channels, access this new kind of deluxe high net worth type buyer and distribute to them directly. So, with something like tokenization of a fund, does it allow us to automate a lot of the kind of back office administrative work? Does it allow us to open up to smaller deal sizes and in turn smaller check sizes for participation in the fund itself? And we sort of saw that was obviously a big headline for us and brought in a ton of interest and just introductory conversations with various asset issuers, all different types of financial institutions. So that really set us up. And I actually only joined Avalabs at the start of this year. So I joined as we were kind of midway through a lot of these early conversations. And where that kind of led us was, and I guess to take a step back, Avalanche as a network, I would say the architecture is a little bit different than some of the other public blockchains that most people would know. So we are mostly similar, I would say, to like a Polkadot or a Cosmos, in the sense that Avalanche is designed and has been designed to scale horizontally via what we call subnets. Subnets are essentially just application-specific blockchains. So you can think about Avalanche as a network of networks or an internet of blockchains, where today we have 50 plus subnets in addition to Avalanche mainnet that all utilize validators from the Avalanche mainnet and all utilize Avalanche consensus, which is the third ever consensus in all of cryptography behind Nakamoto and Classical. That was the real breakthrough that our founding team kind of built around, because what Avalanche consensus does, it enables sub-second true time to finality, very important for financial services use cases, obviously, that you have that finality on your transactions. That's very quick. It also allows for validator sets to be scaled beyond what would otherwise be possible. So you get security, you get scalability, you get decentralization from the large validator set. And in that way, you kind of have a nice out of the box, performant, but also decentralized blockchain. And the other differentiator, in addition to Avalanche consensus, as I was saying, is subnets. And what subnets allow you to do is create a customized execution environment for whatever use case you might be looking to build around. So we kind of got this idea from our conversations with financial institutions that there was a common type of block space that financial players in the capital markets industry were looking for. And we kind of narrowed down a specific type of subnet that we've sort of commoditized, and a configuration of a subnet for financial institutions. And we call this Evergreen. So Avalanche Evergreen is a out-of-the-box application-specific blockchain that has a permissioned validator set. So if you think about for a financial institution, they care a lot about who is able to see their transactions, who is actually validating their transactions. So for instance, we've had requests from banks to limit their validator set to people that they have an ISDA with, for instance. With an Evergreen subnet, you also get permissioning at the user level. So there would be a allow list built into the chain that holds all of the KYC AML data for wallets that are actually allowed to interact with the chain. And that gets stored at the chain level. So the interesting part about that versus what you might come across on like a KYC'd DApp on ETH mainnet, for instance, or even on the Avalanche C chain, which is our EVM mainnet environment, is that if there are multiple applications on a subnet, but the KYC and AML information lives at the chain level, you don't have to do that recurrent KYC process with multiple applications. So that's something that I think financial institutions, and particularly for like institutional DeFi and ideas like this, where you have multiple apps kind of working together in tandem, that's something that removes a lot of friction. One of the other important points on Evergreen subnets would be the ability to have a custom gas token. So this is something that's really important for particularly institutions who can't custody crypto on their balance sheet today, right? So, maybe they're able to touch stable coins, maybe not. It could be something like a tokenized deposit that we actually build in and use to power the network and pay for transaction fees. If that's not feasible, we can do something like a valueless gas token. So something where they wouldn't actually have to do the accounting to keep, that asset on their balance sheet, but they can still use the technology, which is really interesting. The other thing with Evergreen subnets that we've kind of found, and with Avalanche in general, that's been a real advantage, is this idea of building around the EVM. So the EVM is the Ethereum virtual machine. This is all of the tooling that you kind of interact with when you're using Ethereum or another EVM chain like Avalanche or an L2. This essentially allows Avalanche as a chain, and really anyone building on Avalanche, to tap into the open source developer community that's building with Solidity and has been building all of these tools for Ethereum over the better part of the past decade now. So we found that institutions care most today about the EVM. I think with us at Avalanche, we foresee that changing and shifting over the coming years as new virtual machines continue to pop up that are hyper performant and really interesting on the back end for use cases that are going to scale to many, many millions of users concurrently. So at Avalanche, we're VM agnostic. We started out with the EVM. That's what our main net, in terms of the C chain, where you'd be interacting with all of the largest dApps and liquidity that lives on Avalanche. That's all in the EVM today, but we have subnets that are being built that are in new, more cutting edge virtual machines, which I think is really interesting as well. But for the purposes of Evergreen and our institutional subnets, where a lot of these tokenization initiatives live, that is in the EVM today as well. So I think one last thing to highlight about the subnet construct is you essentially have a fully customized application-specific blockchain that can start out as fully private and fully permissioned, but actually has the optionality preserved to open up over time to become more public and more permissionless. And that's something that had not existed in prior iterations. It was basically a binary between private chains, enterprise blockchains, and public chains. And essentially, there were no financial institutions who were able to really interact with public blockchain infrastructure in a meaningful way. So a lot of this stuff has lived on private DLT, and we're starting to see more and more that moving over from private DLT to things like Avalanche subnet, where you kind of have the the compliant aspects of the user permissioning and the validator permissioning and all of the jurisdictional requirements, depending on where you are, right? That can all be built into your subnet. And you don't have to worry about performance issues being affected by something like a Taylor Swift NFT drop, for instance, on mainnet, right? Where fee markets would spike and your actual chain performance would be impacted by these exogenous events that are happening elsewhere in like the crypto universe, so to speak. So for all those reasons, and the last thing I would mention about subnets is that they are built in with a native messaging protocol called Avalanche Warp messaging. So they have the ability to exchange arbitrary messages without the need for a third-party bridge. Third-party bridging is probably the scariest term in all of crypto, especially for financial institutions. So to the extent that there are multiple subnets that are looking to work together, they can cut out that third-party bridging entirely and work together seamlessly. So that's like the last thing I would mention. And the reason I touch on subnets to kind of bring me to the Vista grant program and a lot of what we have going on the real world asset side is because this construct, and it was recently highlighted in Bank of America's tokenization report when they kind of talked about the whole $16 trillion opportunity for tokenization by 2030. Avalanche Evergreen subnets were highlighted as one of the key platforms that tokenization is going to take place on. And the reason I start there is this is like our demand strategy and actually onboarding true asset allocators who are going to, allow tokenization to really grow meaningfully. This is kind of the environment that we're looking to onboard the demand side and the buy side, right? As it stands today, if you have a deal that is, being tokenized and distributed via public blockchain rails, and for instance, we've seen a lot of this with a lot of these on-chain private credit-esque protocols, or even the tokenized T-bill funds and money market funds that have kind of been coming into vogue this year. You're essentially going after this hodgepodge of on-chain entities. So DAOs and protocol treasuries and crypto native funds, these liquid token funds, potentially some on-chain quant systematic type funds or on-chain market makers, and then like the deluxe retail bid from crypto-friendly family offices and high net worths, and kind of the early on-chain whales. It's a very difficult subset of capital to try to round out deals with and try to bootstrap liquidity in a meaningful way. And we don't think that, the next $1 trillion of value that comes onto public blockchains is going to come via these types of personas, right? It's going to be, the asset managers who already have trillions of dollars under their belts. And to that extent, we have one particular initiative that I can speak about a bit, but a number of things going on with these kinds of $1 trillion asset managers. So built on top of Evergreen, we have an institutional DeFi subnet that's currently in a testnet phase called Spruce. And what Spruce is essentially a consortium of buy-side firms like T. Rowe Price, Wellington Management, Wisdom Tree, as well as some other players involved, such as Cumberland DRW, a number of other firms of similar caliber that, are not public today. But essentially what Spruce is a permissioned environment for some of the leading blue chip decentralized applications from DeFi. So Uniswap, Aave, Trader Joe, Volts, which is a really cool interest rate swap protocol, and one or two others that we have deployed in this environment. essentially to use DeFi technology and the crypto rails for transactions with tokenized real world assets. So this would be like a test flow, but we would have T. Rowe Price or Wellington, mint a tokenized real estate token, let's say, and they could take that, they could post it as collateral and pledge it on Aave. They could take a loan out against that in stable coins. That would be a floating rate loan. They could then take that floating rate debt, swap it for a fixed rate debt on Volts, and then they could use that fixed rate debt that they've just locked in to do something productive elsewhere with those stable coins, perhaps on Uniswap or Trader Joe, something like that. So those are like the kinds of test flows that we're walking through with these large trillion-dollar asset managers, buy-side firms, and kind of trying to get them comfortable with this, type of setup, and with public blockchain architecture in general. That's kind of the longer term demand side of the equation. On the supply side, we think it's a very opportune moment to capture a lot of the high quality assets that are sort of looking at tokenization today, and a lot of high quality projects that are building around this concept, because it is a difficult liquidity environment, and just really just a challenging liquidity environment at this point. We want to be supportive for high quality builders and projects that we want to have on Avalanche for the foreseeable future, so that as more institutions are able to really participate on chain and on Avalanche via things like Evergreen subnets, we have this high quality, robust ecosystem of asset supply that's already living here and has been building here. So one initiative that we have around that idea is called Avalanche Vista. Avalanche Vista is a $50 million purchase program backed by the Avalanche Foundation, with which we can buy any kind of tokenized traditional asset on Avalanche, so long as it's issued on our chain and natively lives here. The idea around this is that we can kind of participate in any asset type across the liquidity spectrum, across whatever cash flow or coupon profile or whatever duration profile. We're not really looking to generate hedge fund like returns or venture fund like returns, or even like clip a small yield. There's not really much of a focus around generating alpha. And yes, we obviously don't want to lose money with these funds, and we're expecting these assets to be relatively stable, but it's about supporting the highest quality projects. And what we're really looking for is, how are these asset issuers and these projects thinking about the demand side of the equation and thinking about distribution? Are they going to be onboarding net new users to crypto, and really obfuscating away the ugly crypto UI, UX, and like the blockchain backend, so that a lot of times people don't even know that they're using blockchain, or that they're accessing a tokenized fund, right? So we want to be supporting those kinds of projects who are really thoughtful on that side of things, and have this pool of capital set aside to participate as a liquidity provider, as a lender, as an asset allocator. And we can do interesting things along the way, where perhaps we buy an asset and then we repurpose it into a liquidity pool that where we are passively providing back that liquidity, so that secondary market trading can take place, or something along those lines. I guess I'll pause there, and I know I just went on for quite a bit, but yeah, that's the whole overview of the RWA strategy, so to speak, for Avalanche.
Sure. And so a lot of what you said there is you're looking to bring on institutional investors, and the only way that the ecosystem is going to grow is if the institutional investors join on, create like stable products, and actually if they have those stable products, they can those will actually help the rest of the crypto ecosystem, by providing lending opportunities, leverage opportunities, and yield opportunities. Is that correct, or am I off on some of it?
No, I think that's exactly right. I think for us, we're very focused on going to institutions with a value proposition that is in the first case and primarily focused on like operational efficiencies. So if you think about like just the world of traditional finance, especially post 2008, you have a ton of consolidation in the industry. You have the larger institutions kind of eating the smaller fish and just growing ever larger and more systematically important, frankly. And it is such a game of scale that, and also so competitive in the sense that like, if you have a technology that you can introduce that can meaningfully, cut costs at scale, that's incredibly powerful. And I think that's even more powerful than just saying, okay, you can tap DeFi liquidity or, all of these stable coins, $100 billion of stablecoin liquidity that lives on chain. You could potentially tap that as an additional distribution channel for whatever a liquid asset or fund you're looking to get increased liquidity on. So I think we definitely want to start with like operational efficiencies. What are concrete ways in which we can go to institutions and show them that doing things on chain isn't just a way to potentially tap more liquidity. It's something that can actually save you on the cost side as well.
Eliminate back office expenses, eliminate paperwork, make things much faster and much more efficient. So Luke, we really appreciate you coming here. We really appreciate everybody at Avalanche and Avalabs, and thank you very much. Do you have anything else that you wanted to add before we wrap up?
No, that was all I got. Thanks so much for having me. If anyone wants to chat further, obviously you can reach me on LinkedIn, Luke Schmiel, or through Michael. Happy to chat further on anything we have, or how Avalanche could be useful for whoever. Really, we want everyone building on Avalanche, on subnets. So thanks so much for having me.
Thank you, Luke. Bye now.
Thank you for listening to the Blockchain Real Estate Podcast, hosted by the Blockchain Real Estate Summit. Don't forget to sign up for the Blockchain Real Estate Summit 2024, happening this September 24th through 26th, online for our worldwide audience. Get your tickets at blockchainrealestatesummit.com/registration. If you enjoyed today's episode, please make sure to follow the Blockchain Real Estate Podcast on your favorite platform and leave us a review. Your feedback really helps increase the visibility of our show, allowing us to reach more listeners like you. If you have someone in mind you would like us to interview, you can go to blockchainrealestatesummit.com and leave a comment.
Hi, this is Adam Carswell, the voice of Liberty. This podcast is solely intended for informational and entertainment purposes only and is not intended to provide tax, legal, investment, or accounting advice. You should consult your own tax, legal, accounting, or investment advisors before engaging in any transaction or undertaking. Thank you for listening to the Blockchain Real Estate Podcast, which is a part of the Blockchain Real Estate Summit Network. Go to blockchainrealestatesummit.com for more information, free reports, and giveaways with free stuff. Thank you.